You've got questions, we've got answers. We have the man to answer them. Jeffrey Levine from Buckingham Wealth Partners. Jeffrey, welcome back to another episode of Pass the Hammer.
Good to be with you as always, Bob.
Good to have you. I've got a lot of questions, almost the same question in my inbox from several readers having to do with current events. People are expressing worry about inflation rising, about the Fed increasing interest rates, about stocks being at an all-time high, about the government putting the brakes on fiscal stimulus, and they're worried about what to do with their portfolio.
That's it? That's all the worries?
There's a couple more that I didn't mention, but we'll start there.
Yeah, it's a great question. And look, a lot of this, Bob, comes down to your investment philosophy. There is, broadly speaking, two different schools of thought. You can be somewhat tactical in your positions, or you can be somewhat strategic. The tactical investor believes that they can make significant bets on what is to come in the market, and maybe not them, but through their financial professional or themselves, they're able to make these dynamic shifts with their portfolio to capitalize on current trends. Whereas strategic investors are more likely to be buy and hold. They're more likely to have their diversified portfolio, and they say, this is, I may make subtle adjustments here or there, but this is the right allocation for me, and I will kind of stick with it through the ups and the downs. And ultimately, diversification means something is probably always doing well and something is probably not doing well. That's just that's just what we deal with diversification. So I think the first thing is to understand, what sort of investor are you? There are plenty of people out there on both sides of the equation, and there's good research to support a variety of positions. I tend to be a little bit more strategic, but in reality, most folks are not one or the other. For instance, you might hold a mutual fund with a low turnover rate. Well, are you strategic or are you tactical? Because the mutual fund may be making changes on your behalf, but you're still holding the same position. So in reality, many people, unless you're purely holding like the S&P 500 ETF, right? That'd be about as strategic as you could possibly be. But if you're holding some sort of funds or whatnot, depending upon the fund's relative turnover, you might actually be, and many people are, somewhere in between these two positions. Look, if you're tactical and you believe inflation is going to rise, you do things to help mitigate that risk, right? You're going to be more in terms of things like tips, et cetera, that can help mitigate that. You might scale back your maturities on fixed income so that if interest rates rise, you have liquidity on those investments sooner. You might transition from certain equities that perform less favorably historically in inflationary markets to things that might perform better. You might have more money in things like real estate or other hard assets that historically may have yield inflation hedges. If you're a strategic investor, again, you might allocate some to those, but you're probably just looking at rebalancing your portfolio. Again, you could be strategic and say, I only was going to have 30% in fixed income, but maybe I'll just trim my maturities a little bit. Instead of having an average of 7 years, I'll try to bring it back to 5 years now, or I'll keep more in cash. Everything has a trade-off though, right? If you have more in cash today yields about nothing. If you have a 4 or 5 or 6 year bond, maybe you can get 2%, 2.5%. Not going to set the world on fire, but if you've got a good amount of money saved, it's every little bit counts, right?
So I put myself in the camp of being a rules-based investor, and whether you're strategic or tactical, the notion of having an investment policy statement that guides your decisions. Any thoughts about that?
Yes, I have one. I mean, that is, you're right, rules-based. And when you say rules-based, what it screams to me is remove emotion from this process. If you're tactical, you want to be tactical because X happened, and when X happens, you do Y. That is your rule. If you're strategic, your rule is essentially, look, this is my portfolio. My rule is I don't panic. I stick with my investments for the long term because historically we can show that, low turnover and this allocation, whatever, that's fine. But that is your rule. When markets go wild to the upside or to the downside, right? When things are, no one ever complains about extraordinary volatility to the upside. Like, oh my God, my account just went up so much. But it does create emotion. Sometimes people say, gee, I should put more in the market because look how well it's doing. Well, if you're a strategic investor, you say, you know what? I do want to be involved in that growth, but I already have some of my account there. I'm in the right mix for me, because if it goes back the other way, and it's been a long time since we've really seen an extended bear market, right? We had a blip of, last year in March where we saw the markets kind of temporarily crash, but they finished the year up dramatically. So look, at some point, we're likely to have a bad year. It's been a long time. We forget that those things can happen. But that, I think, you're right. Having the investment policy statement helps to remove emotion, because when you get emotional, you look back at that piece of paper and it commits you. It says, this is what when I was unemotional about this, when I set forth my investment strategy, this is what I said was best. And so it improves or increases the chances you will stick with that strategy over the long run. If you've got a financial advisor, I certainly hope that that's included as part of your process. If you don't, I still suggest you have an investment policy statement. Google a little bit about it, research it, and ultimately write yourself a note like, dear self, here's what I'm going to do. This is my investment philosophy, and this is how I'm going to stick to it. Ultimately, do I think a professional can help guide you here and help remove emotion, be that counterbalance to when things are good, help keep you grounded, and when things are bad, help keep you, sticking with your strategy? I do. But if you're one who likes to do it yourself, you can do yourself a real service, as well as for your family, by committing to pen to paper and writing out that investment philosophy in your own customized investment policy statement, so that you have it whenever things go too well or too bad.
Yeah. So I'm hoping that all the readers and viewers who asked that question can come away from this saying, let me worry. I have an investment policy statement.
That's right. Look, we don't know what tomorrow will bring. And I'm fond of thinking about, how right can I be, right? So if you ask me, will the market be up today, Bob? I'll say yes, but I'm only going to be right, a little bit more than 50% of the time. If you ask me, will the market be up this year? I'll say yes, but I'm still not overly confident, right? Maybe we're going to be 3/4 of the time, roughly. But if you ask me, will the market be up over 10 years? The answer is going to be, I'm going to say yes. Now, I won't always be right, but I'll be right almost all the time. And so just taking that long view is important. Understanding your time horizon. When will you need money from your portfolio? If you need money sooner, you have less time to wait. And so it generally means you have to be a little bit more conservative. If you're also worried about inflation, you probably need to hold more cash, because that is, while inflation eats into your principal value, like your real dollars, how much you can spend in cash, it is at least something that you don't have to worry about going down in value because inflation, right? In terms of the actual amount you see in your account.
So I know you say you're not sure what tomorrow may bring, but I'm hoping that it brings some more questions.
Any day I wake up with questions in my inbox is a good day. So I'm hoping for more of those. If you'd like to help Bob and I have a great day, just do us a favor. Email us your questions here at askthehammer@buckinghamgroup.com. Again, that's askthehammer@buckinghamgroup.com. And Bob and I look forward to tackling your questions and having that good day real soon.